Good morning, everyone, and welcome to the ESG Exchange Tech Talk. And today is going to be really an exciting, in-depth technical discussion around single, double, and impact materiality. And I'm sure everyone on the call is dying to hear what the various board members have to say about this. So we have Carol from GRI, Wim representing EFRAG, and Richard representing the ISSB. So really the three most used standards driving across the world. Maybe just let us know where you're from. In the chat function, there's Baba from Sydney. It must be really late for you. Thank you so much for joining us. Yeah, if you're just joining now, please do let us know where you're from in the chat function. We have France, we have Johannesburg, Austria, lovely, Sweden, Denmark, Singapore, really nice, and India. Welcome to everybody. If you have got a specific question to ask, please use the Q&A function to ask your question so that we don't get lost in the chat function. We are going to run some polls. We're going to leave the polls open for 2 minutes to be able to answer, but please, when they come up on your screen, do answer. We are going to use this information once we've finished our materiality series of tech talks to just have a look at what you have said in response to our poll question. So please do join us. Without any further ado, I'm going to hand over to Peter. If you like anything that any of the speakers are saying, we have opened the reactions button, so you are welcome to have thumbs up, etc. But without any further ado, thank you, Peter. Peter is our chair of our technical committee. Over to you.
Thanks, Carolyn, and good morning, good afternoon, good evening, good night to you all, wherever you are. I'm going to give people maybe just another minute. We'll start promptly at 2 past the hour. And inviting you all, just let us know where you're from, and please do participate, because we would hope that about 5 or 10 minutes to the hour that we'll be able to take questions from you, the participants, and we put those questions to our panelists. So we're now at 2 minutes past the hour, and I'll get into the formalities to get us going and so forth. So welcome to you all. This is the 5th ESG Exchange Tech Talk, the last in the current series of materiality discussions, co-promoted with EFRAG, with 3 board members, Wim Bartels from EFRAG itself, Richard Barker from ISSB, and Carol Adams from the GSSB, and kindly sponsored by Archer IRM. Before I get into today's topic, I was going to ask Carolyn there to maybe share her screen and show us all the landing page, the ESG Exchange landing page. And I want us all just to zero in just for a moment on the purpose of the ESG Exchange and why we're here. The problem statement that we're responding to, if you just see there, Carolyn, just scroll up a small bit more, the problem statement is that there's not enough expertise, global expertise in the world to get around to help all the corporates that need assistance to move their sustainability needles for planetary and societal effect. Consequently, our purpose is to rapidly globalize the scarce expertise that exists today, put it on a digital platform, get it out free to sustainability managers, finance functions, risk functions, and so forth. And our vision is that of a common set of global principles to help organizations operationalize what needs to be done. And in that particular regard, our mission, our ambition, our impact objective is that of bringing 10 million directors and managers from 10,000 global organizations through sustainability fundamentals between now and 2030. We're not forgetting the small and medium-sized enterprises. They'll also be able to access our how-to playbooks. And we're also acknowledging that the global 10,000 will have this trickle-down effect in obligations that they'll be placing on their value chains. Our first mission has been achieved, which is that of convening the global reporting ecosystem, reflected here in the circles, and the logic to the way they're grouped within the circles here is they are evident on the left-hand circle. And our second mission then is to mobilize and convene the actual global experts. And at this point in time, experts are being nominated by the organizations you saw in the very inner circle and the outer circles and so forth. and we're organized into practice groups, and we have commenced that work in the last couple of months with practice groups from everything from tax transparency to biodiversity, climate, decarbonisation, pollution, and so forth, largely reflecting the 10 topical standards and more, also significantly influenced by GRI and their guidance as to topical areas. So, Caroline, we can stop sharing that screen. And by way of introductions, Wim Bartels. Wim has worked in sustainability reporting and assurance since 2003. He is currently a partner with Deloitte for their European organization. He has worked with over 50 multinationals across Europe and has worked also working globally. Wim has been a member of the Task Force on Climate-Related Financial Disclosures since its inception in 2016 till December 2021, and has been the program lead for corporate reporting dialogue from 2017 to its sunsetting in 2021. Currently, Wim serves as the chair of the Sustainability Policy Group of the Council of Europe. Furthermore, he is interim lead of the CFO network of the World Business Council on Sustainable Development, and he's a member, of course, as I said earlier, of the EFRAG Sustainability Reporting Board. Richard Barker, I'd like to thank him again, by the way. Richard's on annual leave this week. We're quoting in his personal time, but he saw fit to join us this morning. And Richard, I want to thank you once again for that. Richard was appointed as a full-time member of the International Sustainability Standards Board in June 22, with effective from the 8th of July. Before joining ISB, Richard served as Deputy Dean and Professor of Accounting at Sade Business School, Oxford University in the UK. In this capacity, he led Oxford Sade Sustainable Business Initiatives. He has published a wide range of academic research papers on accounting and sustainability disclosures. He has chaired the expert panel of Accounting for Sustainability, A4S, and served as a member of several committees and bodies focused on corporate reporting in the UK and Europe, including the UK's Corporate Reporting Council, the Financial Advisory Board, and the European Accounting Association's Accounting Standards Committee. Professor Barker served as a research fellow at the International Accounting Standards Board from 2001 to 2007. And he's got a bachelor's degree in history and economics from Oxford University and a PhD from Cambridge. Finally, Carol Adams, chair of the GRI's GSSB, is a chartered accountant. And also chairs the GRI's, as I said that, and she's a chartered accountant and professor of accounting at Durham University Business School. Her research is concerned with the role of accounting and reporting and the relationships between business, society, and the environment. She has led the development of sustainability reports and advised on sustainability and integrated reporting to major organizations. Recent policy work for Carol has included advising the UNDP and its SDG impact standards and the CIPFA on public sector sustainability reporting. Carol has sought to advance practice and policy with respect to integrating sustainability considerations into organizations through applied research, leadership roles, advisory work, and educating the next generation of business leaders. As always, our ESG Tech Talks, focusing, given the topic that we're discussing, a double materiality here today, single, double, and impact materiality. What matters most? What are the challenges for you, the participants in real organizations seeking to apply, fulfill your obligations, the regulations, but applying the standards in that regard? What are your challenges as we see them? And what are the insights which our panelists can share with you all? So our first question, in the context of single, double, impact materiality, are they all equally material, being somewhat controversial to get the conversation going? Wim, can you explain in the first instance, really tough question, what is double materiality?
Yes, thanks so much, Peter, and great to be here with so many from around the world I see in the chat. So that's really great. Congratulations on that. Yeah, double materiality is a key concept, is the key concept, if I may say, in the European Sustainability Reporting Standards that fall under the Corporate Sustainability Reporting Directive that the EU has released and approved early this year. And that concept comes from the notion that in getting to a sustainable economy, we need to know about the material, so significant impacts that a company has on its environment and the people that it relates to and with. And then also that in getting there, we may also face financial risks and opportunities, so financial effects from the company's activities, locations, and business. And the CSRD has called that concept double materiality. It is about the impacts of a company, the inside out on the one hand, and it is about the impact of the sustainable development as such in financial terms on the company. So that's the outside in, and that concept is critical in the standards as it informs effectively the topics that a company needs to report on under the European standards. And then further, it goes into what you would need to report in each of the topical standards that the ESRS contain. So that is, I think, the concept of double materiality as an intro. And maybe Carol and Richard will talk a bit more about both dimensions, but maybe this is good to set the scene on how the EU looks at it in its reporting standards.
Okay, thanks for that, Wim. And at the end of this particular round of questions, we're going to be asking people a simple poll question if they understand what single, double, and impact materiality is. And at the end, we'll be asking you, do you understand how you would apply single, double, impact materiality in your organizations? So please be thinking of that and don't be shy in asking questions of our panelists. Richard, from an ISB perspective, single materiality, or more correctly, perhaps financial materiality, can you explain to everybody what that means in very practical terms?
I'll have a go. So, yeah, materiality for us, I think the very simplest way to think about it is information that's useful to investors. So it's a core part of traditional financial reporting in that sense. So we have exactly the same materiality lens that the IASB has, which is concerned with providing information that could reasonably be expected to influence an investor's decision. So, and the same definition is used by ESRS in their financial materiality definition. So this is important to say that it's not just materiality with respect to financial statements, right? So if you think about financial reporting historically, you might think about materiality in the context of is the information material for inclusion in financial statements? But corporate reporting is broader than just financial statements. And so for us, sustainability-related financial disclosures are material to investors if they are reasonably expected to affect investment decisions. So to give you an example, if you think about how accounting is used by investors, you take sort of profit that the company has reported in the past and you use that as a guide to how much profit the company will make in the future. And accounting is an incredibly important foundation for valuation in that regard. If the future is going to look very different from the past because of discontinuities associated with sustainability, climate change being the most obvious one, then there is a need for information to supplement the financial statements so that investors can make better decisions about how what they're invested in is impacted by, is influenced by, is subject to issues of sustainability. So for us, materiality is all about reporting risks and opportunities with respect to the entity's relationship with its the resources on which it depends. So you've got an area that's exposed to flood risk or something, or you're an insurance company and you're choosing to withdraw insurance for a region because it's at risk from climate effects, whatever it happens to be. If the information about those things is something that can affect an investor's decision, then it's material for disclosure from our point of view. Notice that could include information about the entity's own impacts. So if an entity, if the activities of an entity, for example, have a direct impact on the sustainability of its own supply chain, or that create reputational risk or whatever it happens to be, then those things can be financially consequential to investors. So it's not the impacts per se that are the useful information, it's the consequences for risks and opportunities for investment decision making. So think about materiality from an ISSB point of view as being all about communication between a company and its investors. And in that sense, there's nothing different in thinking about materiality in terms of sustainability than we've always thought about materiality from a financial markets point of view. It's about providing useful information to investors.
Thank you. And what you've been sharing there with us, reminds me that there are places when I read through S1, in particular S1, and of course S2, and I see, really you wouldn't put a sheet of paper between what you describe in Objective 2 and Appendix B and all that kind of good stuff, and what's advocated by the CSRD and impact and so forth, because the thinking, the philosophy, the non-financial sustainability matters that can affect financial performance. You're acknowledging those things. So, Carol,
current and prospective, current and prospective financial performance. That's right.
Yes. Perfect segue into Carol. Impact materiality, or am I describing it correctly at all? Is it impact materiality? Can you describe it? Or maybe comment on what Wim has said and Richard in the context of the GRI perspective, the GRI being the thing really which has fueled what we see in the ESRSs and so forth.
Yeah, so to do this, we really need to go back to what GRI means by sustainability reporting. So it's about how an organization contributes and aims to contribute to positively or negatively in the sense of what it's done already to sustainable development. And we think about sustainable development in the same way as the Brundtland Commission. So development that meets the needs of the present without compromising the ability of future generations to meet their own needs. So GRI standards enable organizations to disclose the most significant impacts. That's the term we use, the most significant impacts on the economy, the environment, and people, including their human rights. And we set out in GRI 3 a number of steps to getting there, which have been incorporated into the ESRS. So these are essentially the same steps in both sets of standards. So the first one is to understand the organizational context using the sector standards, understanding the activities, the relationships, and the stakeholders of the organization. And then identifying the actual and potential impacts of the organization and assessing the significance of those impacts. And that involves engaging with stakeholders, talking to experts such as academics, NGOs, lawyers, and so forth. And then once you've assessed the significance of impacts, you prioritize the most significant impacts for reporting. Now, the impacts are one part of it, but of course, to effect the change that GRI standards are helping organizations to do, we also need to have the reporting and the disclosures on the governance oversight. So GRI has a number of disclosures in its universal standards on governance oversight, including, for example, the responsibility for managing those impacts of the organization. Who is responsible and how is that done? And then we also ask for disclosures on strategy and policy, because that's a key part of that change process. So we ask organizations to disclose their strategy for contributing to sustainable development, their policy commitments around this, including, for example, their policy on human rights and biodiversity, and how those policy commitments are integrated into strategy and implemented. Now, who uses this information? Well, investors are a key user of this information. So they want to know how impacts are integrated into strategy and the business model. And they use those impacts as a route to also looking at how risks and opportunities have been identified by the organization. If they have the information on impacts, they can make that assessment themselves to assess the long-term success of the organization. And other stakeholders also use it for those purposes, but in addition may have additional reasons for looking at the information on the organization's most significant impacts. So that's the term used in GRI standards to achieve that purpose of helping organizations for their stakeholders and their investors move towards sustainable development and making a positive contribution there.
Okay, just before, Evelyn, maybe you can prepare the first poll question, but I see, Wim, do you want to ask a question of Carol there? I see your hand is up.
Yeah, thanks. No, I just wanted to reiterate a few points that Richard and Carol alluded to already, which is maybe first of all to say that hopefully the attendees today heard that between us there's really interoperability. So you can use the one standard in conjunction with the other. If you apply GRI materiality, you would effectively also be in accordance with the impact materiality side of ESRS, and similarly, as Richard said, for the ISSB standards. But the few things I wanted to highlight, and it has been said by Carol and Richard, but that is where it is about significant, it is both about actual and potential impacts. That's one. Second, it is about positive and or negative. Thirdly, it is to regard the full value chain. So it's not only your own operations, but really look into the supply chain as well as downstream to customers and users and even communities. And finally, and maybe we did not highlight that so much, is it is really also about the long-term thing that is implicit in the GRI standards. And also in ISSB standards, but just to highlight that this is really like looking not only next year or a couple of years, but also the long term of the company, because some of these impacts and financial effects may really come out only on the long term, but irrelevant for the users.
Thanks, Vin, for that. I mean, I've often thought myself that the context of ESG, the kind of shorthand for sustainability, that's just these data. But they're being used, I think, by investors as a proxy for the likelihood of sustained performance, And of course, sustainable performance means one thing in the context of Brundtland, and something quite different in the mindset of most business people. But Evelyn, can you just give us the results of the poll there? I'd be interested in finding out if people feel that they understand the difference between single, double, and okay. Okay, so I think there's an improvement there. I think we're getting better. Yes, we think we do. I think 12, 18 months, 24 months ago, it might have been as clear. So that's interesting. And certainly there's very few that would say no. So that's good. Okay, great, excellent. Next question, and I think I'm going to go back to you again, Wim, but you kind of touched on it earlier on, but this relationship, and this is where we have to kind of unknot stuff, because there are thousands of organizations in the world today that will need, we look at their disclosure obligations with effect from 25. They're going to have to disclose under single, double, and impact materiality, and they're going to have to demonstrate how they did what they did and the results of what they discovered in doing all of that. So the relationship, can you maybe speak to that, please?
Yeah, sure. And I see the poll results being shared again, and I can say from my own experience, by the way, also at EFRAG, that we think we do is a fairly right answer. I think and many of us are now really finding out how to do this and relate to the challenges, but we will discuss that expectedly. So on the relationship, I think, well, again, Richard and also Carol already alluded to it, that there is this relationship. The question is always, how strong is that? Is that a one-on-one, a by definition relationship? That can be further discussed, and maybe again Carol and Richard can say a little more on that. But I think the relationship is this: if you have and personally, I think it should start there. If you have an impact on the environment or on social circumstances, then that impact, of course, needs to be reported, as Carol, I think, explained. If it is significant, then that impact may turn into a financial risk. If you have carbon emissions, you may be taxed now or in future. You may face a risk from changing consumer demand now or in future. So that's where an impact can turn into a risk. Let me give a very recent example. Actually, it is of yesterday in my country where I live, is Netherlands. One of our Dutch companies pollutes the environment with PFAS. This company does so for a long time. So that's the impact of that company on the environment. Now, this impacts apparently the health of the people that live around that facility. It has now become a legal proceeding, and the judge has said you are liable for the damage that you created. So this will turn into costs and maybe other financial impacts for that company. If that company would not have that impact, then of course they would also not be subject to that financial risk. So that's where an impact can turn now or in future into a financial risk or an opportunity. Of course, we should not forget the positive side. But this is, I think, how I would explain how the two relate to each other. And then I don't know, maybe Carol and Richard will build on this.
Okay, Richard, the relationship. And the practical application of that relationship from the perspective of particularly, the thousands of organizations that need to disclose under a single double going forward. Your take on it?
Yeah, so I think I would think about materiality as about the audience primarily. So, differences in materiality about differences in audience, right? So, you can't. So, information in and of itself is not useful without thinking about context, right? So information is useful to a particular user in a particular context. If you think about ISSB, information is useful to investors in making investment decisions. And so the example that Wim just gave is a really good example of why an investor might be concerned with impact, because you have a case there of impact on a societal impact on a local community. In that case, that becomes a financial risk because there's a litigation going on, right? There's a fairly clear and direct consequence for the business. So for us, the audience is investors, and I guess there are two things to focus on there in terms of difference with other versions of materiality. One is that impacts might become material to investors, but they might not. So it would be a lovely world in which all corporate impact was in the interests of companies to address, and was it's something that was front of mind for investor decision making. The reality is the externalities exist, positive and negative. And current and prospective, and so there is a difference between the impact that companies have and the impact that the corporate sector has an economic incentive to address, as it were, and that I think is important not to overlook. There's also an issue about level of aggregation of information, and type of information. So if you're the local community affected in Wim's example, then you might want to know, well, how am I affected? What diseases am I exposed to? Or what sort of illness am I exposed to as a result of this? What property damage? What's it going to do to the value of my house? Whatever it happens to be, right? So the impacts on the stakeholders are different from the impacts on the investors, which are expressed in financial terms. So if you're reporting to your investors through an ISSB financial materiality focus, or we don't actually use the term financial materiality, but anyway, from an ISSB perspective, you'd be saying, well, how is this going to affect your investment? Whereas I think in principle, if you're reporting impact to your stakeholders, you're saying, dear stakeholder, how does this affect you? So the very same event could be reported at a different level of aggregation and a different type of information to those two different stakeholder audiences. The other thing to stress as a point of difference, Carol described the SDGs and the sort of a focus on how is the business impacting the world, which is absolutely at the heart of what, in a sense, what sustainability is all about. But from an investor point of view, your concern about your investment is not just one of for what am I accountable? What are the impacts I'm having? You're also concerned with how are the activities of others impacting me. So so you may be a business with a very low carbon footprint, but you have operations that are subject to climate risk, and reporting the extent to which you are subject to climate risk is a part of single materiality, as it were, ISSB materiality reporting, even though it's not directly related to the impact of the entity itself. So from a financial reporting perspective, from an ISSB perspective, impact is part of the story, and dependency is also part of the story. So I see these things as being complementary. Actually, I think so. You described, Peter, that there being little difference. In some way, I think that is the case for certain types of information. But I think there is a significant difference in principle that we shouldn't lose sight of. That a sort of public societal need for sustainability information and need for sustainability transition is not quite the same thing as the information that investors need to understand. And so having both sets of information, actually, I think is super important. Let me stop there.
Thanks, Chris. So I think what I'm hearing is that effectively, depending on the people you're communicating to, investors that require information for investment purposes, that you apply single materiality. It's kind of a lens thing. And then I look at my other stakeholders, and they've got different interests, different requirements, be the internal or external stakeholders, and I maybe use the CSRD, the ESRS, as the lens that I use to communicate with them. Am I right or am I wrong? And Carol, maybe in the context, segue into you, the relationships and so forth. Am I hearing what Richard and Wim are saying there correctly, or what's your take on the relationships here? You're on mute just now, Carol.
Yeah. So the ESRS have the same approach as GRI in that you have to start all of this with identifying the significant impacts, and that is then the route to identifying risks and opportunities, and which ones are financially material. So what we think at GRI, what the GSSB thinks, is that the impacts of a particular organization and the cumulative impacts of many organizations over time might put dependencies, might be a challenge for things the organization depends on. And both those impacts and the cumulative impacts of many organizations over time and the threat to the dependencies create risks and opportunities that affect the organization and are relevant to investors. So we believe that those significant impacts need to be identified. And you might go from that process in GRI3 that I described before to put the impacts into your organized enterprise risk management system, and then think about the risks and opportunities attached to those impacts, and then look at whether and how they create actual potential financial consequences over time, those risks and opportunities. I really struggle to see how you can do it any other way. A lot of organizations that I have worked with through research and so on, I've asked them, why did you start doing sustainability reporting? Why did you start using GRI standards? and they start doing it because they've been caught out. There's been an impact, and they haven't anticipated how that would affect their business. So, for example, and I won't name it, there was a very big sports clothing brand some years ago that was found out there were labor rights issues down the supply chain, not in its immediate organizational boundary, but down the supply chain. The end of that was that there was a massive boycott of their products, a very well organized boycott, which had a huge effect on their revenue. Now, had they been thinking about their impacts and managing their impacts as GRI standards require them to do, and as the ESRS has been incorporated into ESRS, they could have avoided that situation. They would have been aware, because they'd have gone through this process of identifying their significant impacts. So, to the mind of the GSSB and GRI standards, that has to be the starting point, identifying those significant impacts. And that then helps prevent organizations getting caught out by risks that they hadn't anticipated. And they're also managing those risks and disclosing how they're managing those risks. And that information is wanted by investors. We know from responses to consultations that investors want and need that information, and that information informs their decision making. It's not about us putting selected impacts into standards. What we ask organizations to do is identify their significant impacts and then use the standards to report on those impacts. And that's quite an important, that's quite an important thing to sort of grasp. You can't put selected impacts in standards and think you've got the key risks and opportunities covered. The organization needs to go through that process. In GRI 3, it needs to disclose that process as GRI 3 requires. For investors to have that comfort.
Thanks, Carla. We lost you there for a moment, so I think you finished talking.
Oh.
Can you? Yeah, that's fine. No, just for 2 or 3 seconds. As Evelyn, maybe if you could put up, Evelyn, our second poll, the relationship. Do you understand the relationship between single, double, and impact materiality? And just as people are thinking about that question and providing an answer, my background in the context of risk governance and strategy and so forth is kind of, it's a bias. I see this broad area of ESG and sustainability. What I'm hearing from the panelists this morning is that, ESG is the shorthand for sustainability. It's essentially just old risk management wine in a new bottle. Because what's a risk? Risk is a thing which can slow us down or help accelerate the achievement of an objective. That's all it is. So effectively, it's just good management. Coming into our last question, I want to have about 5, preferably 10 minutes for Q&A with the participants. Evelyn, do we have the results of that second poll that we could maybe cogitate on for a few seconds? Cool. Okay. Yep. We're getting there. I think we're certainly getting there. I'm not going to ask for a commentary on this because the honors question. So the first 2 questions were kind of past questions. We now have an honors question for our 3 materiality or global rock stars, as it were. So, it's about, the question really is in the context of when do people start to apply their single, double, and sustainability and impact materialities. But I want to do it in the context, I want to narrow it. In the context of the thousands of organizations that are required, they've got obligations now in the next couple of years to report under single and double at the same time. How are they going to do that? So, the when and the how. And again, go back, Wim, to yourself, our third and last question. When do they need to start applying? double materiality, given that they're obligated to respond to disclose under both at the same time.
Yeah, yeah, and I saw a number of questions coming in on like how do you actually do this? And again, I think we do answer. I surely relate to, because we see, of course, the challenges. So let me capture a few things. So one is AFRAC is working on guidance, on materiality guidance. That will really be guidance, because we cannot say how you should do it, because then it is regulation, right? So we are working on it, and it's coming, I think, in the next month, 1.5 months or so for consultation. That guidance will give an illustration of how you could do it. And how does that work? Well, first of all, I think I should say this is a bit of a personal note, but I would say don't overcomplicate. So don't try to make this a very complex process with engaging all and everyone, because then you get lost. And particularly if you start with this, you need to start from what Carol said a few times, what are my most significant impacts? How do you do that? Well, you start looking, I think, at your business model. What do we do? What do we make? What do we buy? Who do we sell to? What does happen with the end product? That is, I think, what you should start with. And if you know your business, and you do because you have a business, then you know what are the impacts environmentally and societally. But then you might say, yeah, but how do I know that I capture all the relevant social and environmental impacts? And don't forget the G, the governance, by the way. Well, there are, I think, two sources. One is, and that is required under these standards, is to look at the list that is provided within the ESRS. Technically, ESRS 1, application requirement 16, gives you a full list of topics and subtopics. And that can be a very good basis to say, do I have any of these impacts? Then the other is to look at your industry peers, external developments. That will inform you also whether you miss something that is not in that list, but is still relevant for your business. Then after that, and now you have a long list. After that, it is engaging with stakeholders internally and externally to get their views. What of this long list do you think should be on our short list, should be our most significant impacts that we need to report on? And important question, do you miss anything? Is there anything else that we may have missed in our initial analysis? That would give you a reasonable, complete list of topics that you would need to report on. And then you get normally, and that's how I also see it in practice, you would go to, but now the other side of this, what about the financial risk and opportunities from those impacts? Are there now, or may there be in future? And there it becomes, of course, somewhat difficult, because this, well, I can take climate change. We know this for a very, very long time, minimum 50 years. And no one really cared about it. So no one saw a financial risk and opportunity until somewhere 2017, only 5 years ago. But it was there for a very long time already. So that PFAS example that I gave, same story. It was there for 50 years. They didn't act on it. Now it is a financial risk. So this one is a hard one. But you would, I think, need to look into the current situation that is there already, and extend that into future possibilities, if I may say so, in financial terms, and then assess, could that become relevant for investors? And of course, this needs refreshing every year. I don't give the full process now, also in light of the time, and allowing also Carol and Richard to comment, but these are, I think, some important points to start with.
Thanks, Wim. Richard, the organization that's caught by CSRD and ISB at the same time, when and how does it apply in that context, single stroke financial materiality, given that's got to do it as well through the CSRD lens at the same time?
Yeah, so first thing I would say is to endorse Wim's comment about not overcomplicating. I do think that's hugely important, and not least, the requirements here are not to report accurately on day one about everything in a way that's unambiguously comparable with everybody else, because that's not realistic and that's not going to happen. we are, so it's a sort of well-worn statement, but we're on a journey here, right? And we're at a relatively early stage on this journey, and getting going is super important. And acknowledging in your reporting the extent to which you are estimating and making it clear, or the limitations of what the information you currently have, is fine. That's good reporting, right? So, so I think it is important not to overcomplicate. It's also important, I think, to emphasize that the underlying data that you're collecting, whether it's a single, double, or whatever, is going to be very similar in many respects. And so the way you communicate it to different stakeholder audiences might be different, but the data you're collecting is likely to be very similar. So if you think about climate, which is the obvious sort of point of overlap between the various standards, the most important and most time-consuming, data-consuming part of the process is collecting the data on emissions in the first place throughout your value chain. Those emissions data are going to be relevant to you whether you're taking a single or double materiality lens. Now, the next thing to do is to think about, having collected the data, is to think about the different audiences you're reporting that information to. And so you are going to report different types of information to different audiences. So if you're reporting to your investors under ISSB and also under ESRS, you're explaining to them what they need to know. What sort of scenario analysis have you done that gives you insight into the risks and opportunities that you face? What transition plan do you have to get to net zero? What are the current and prospective financial consequences of that transition plan? And therefore, if you're an investor thinking about investing in this business, what do you need to know, right? So notice the kind of information that is in that as it were, financial materiality lens is focused on take the business's exposure to climate and its impact on climate and translate that into information that's helpful to investors in making investment decisions. So that's what all the risk and opportunity type stuff is about. I do think it's important to emphasize opportunity as well as risk in all of this, and that's not at all downplaying the sustainability issues involved. It's recognizing that a future world in which does not develop sustainably is far less valuable than one that does develop sustainably, and so people respond to economic incentives. And the economic incentive to develop a sustainable world is a hugely important driver of change. And you see that across all kinds of industries at the moment. So reporting on opportunities is also super important, not just reporting on risks. And the final point, just to, actually two more points, one more point, just to emphasize the importance of reporting not just on the entity's own impacts, but on its dependencies, if you're reporting to investors. So, if you're, the Rhine River's been drying up over recent summers is an illustration. Companies who rely upon boats going up and down the Rhine are not responsible for it drying up, but they are affected by it. And so that is, from an investor's point of view, they need to know, they need to understand that supply chain disruption and the consequences of that, but that's not an impact issue as such. And I said there's one more point. Yes. So the other point is in thinking about audiences, from our point of view, being able to separate the reporting to investors from information that is not material to investors, but that is material to other stakeholders is important. So, and we refer to this as obscuring, right? So materiality means not just presenting information that is relevant to making investment decisions. It also means not obscuring that information with information that's not material to making investment decisions. So there is a distinction in terms of reporting to particular audiences that's important. But as I just the starting point, the ESRS and ISSB have the same definition of material to investors. ESRS goes over and above that because it requires information, impact information as well, that is not material to investors. That's the double materiality point. So there's absolute compatibility with reporting to investors and reporting incrementally to other stakeholders. The overlap with GRI is that you need to understand the impact on your stakeholders in order that you can understand the kinds of examples that Wim gave of the Dutch business, right? So and the way Carol described, talked about understanding impacts is obviously very important to any company in understanding its own risks and opportunities, right? If you don't know how you're impacting your stakeholders, then you don't know what potential transition risk or litigation risk or switching consumer behavior, whatever you're faced with. Let me stop.
Thanks, Richard. Just mindful, by the way, as I lead in now to Carol for the last contribution, that in the context of the purpose of the ESG exchange is to produce how-to playbooks. The customer is the 10,000 global corporates. Taking, for example, was it a 48-page document, the first document, the guidance on double materiality we saw from the 10th of August board, Wim, I forget what date it was, but how do you set something like that up programmatically across a 100,000, 50,000, 10,000 person organization? That's tough. Organizations need stuff that's programmable, that's repeatable, that produces good, relatable data that can be trusted. So for folks that want to learn more, keep tapping into the ESG exchange, and we'll begin to produce these prototypes over the next short number of months. Carol, unknotting all of this, the when and the how for the corporate that has to do single and double at the same time. Your words of wisdom. You're on mute, Carol.
Sorry, as Wim has said, because GRI and ESRS have the same process here. You start with identifying the significant impacts of the organisation. That's the starting point. And Wim said, basically, who knew 50 years ago that we'd have this problem with climate change now? So it is the case that the cumulative impacts of many organisations over time create problems for investors and their stakeholders in the future. This information is not just for stakeholders, it's also for investors. Investors want to know about the impacts so they can make this assessment about the risks and opportunities themselves. If you feed that information into an enterprise risk management system, and also think about things, as Richard has said, about things like the physical risks of climate change, which very few organisations report on now. This is a big gap in reporting. Including those things, think about those risks that have arisen due to the cumulative impacts of a number of organisations over many years. Then that also feeds into your enterprise risk management system. And then you've got a full set of data in there to then think about, well, when is this going to become financially material? Because we would argue that all of those significant impacts at some time are highly likely to become financially material to investors.
Okay. Evelyn, I wonder if you could prepare our last poll question. Just as you were talking there, Carol, I was mindful of, ESRS 1 and the kind of the crossover point from the impact assessment to looking at the financial materialities. It's that kind of dependencies on relationships and resources. And then when you have your buckets, your different impact buckets, and they'll all be of different, different bubbles or whatever, they'll all have different sizes. The final question is, they more likely than not, which impacts are more likely than not going to have a financial impact. That critical step over in ESRS 1 is the result of that information for the finance function is perhaps another guide to us. So this question here is, do you understand when you need to use single double impact materiality in the context of your own organizations now, just to make it a little bit more challenging? We've 7 minutes to go. I'm delighted that thank you panelists for keeping the answers to really naughty questions short, because we have a few minutes now, 5 minutes at least it seems, to take questions from our participants. But just before we get our first question from participants, if I could ask Carolyn, here we go. Okay, that's better than, okay, we have only, let's say, a third who are definitively no, but the majority of people seem to have a sense, at least, of when to apply single double impact materiality. That's excellent news, I think, at least. Carolyn, you've been monitoring the questions and the chat and so forth. Is there any, what particular question would you like to call out and put to the panelists?
I think, first of all, to say, Peter, that I've been in the background trying to sort out a technical issue with Zoom. So we had a limit of 500 participants, but actually our limit is 1,000. So I've been responding to emails for frustrated people not being able to get on. So just to know that this group is really, the talk has been very, very well received. I think the question from Suzanne is really good. Investors seem to be in the center of the reporting activities, but how can SMEs that are not financially oriented benefit from? And there's a question on CSRD reporting specifically, but I think it's more broadly, is that we are thinking about the very large organizations and determining their materiality. But for an SME, are we going to just stay with a single materiality because it's easier to do, or is it important for the SME sector to do to look at others, the impact and double?
Who would like to grab that? Carol, hand up first. Okay.
So to me, it's a process. It's not one or the other. It's about where you start. And for me, an SME needs to look at its impacts and think about also some of these major risks that have risen because of those cumulative impacts of organizations over time. So it's not necessarily one or the other, it's about where you start. And I would say that impacts are the starting point.
Yeah, and if I can add from the EU perspective. So first, we are developing, I should say, standards for listed SMEs that is required under the CSRD. We're also developing a voluntary standard for further SMEs because we can see that this will become relevant also for SMEs. So that is first to say that this is coming, not by the way in the coming year, because we'll have European elections. So that is a kind of in between us and the standards. But that said, for SMEs, maybe building on what you said, Carol, over time, this will also impact SMEs from two perspectives. One is they are part of the value chain. So apart from the reporting, they may be required to act on certain impacts they have that they better start thinking about now in a simple way, as we discussed earlier, I think. The second, I think, is starting to think about this. You will become, well, Carol, you said part of the process, right? This is a development that will not go away. If you start looking at it now, you can think about your business model. You have time to change your business model, and you may even get behind the idea of sustainable development for all of us. And if you do, then this is the moment to start with it. Would that then also inform you about your financial risk? Yes, it does, right? So many SMEs have a limited number of large clients. Let's take automotive for the sake of example. Well, if you are in the automotive sector, you better be prepared because this automotive sector is completely transforming. If you're in the wrong part of it, your part of that automobile ultimately may no longer be needed. Well, then you're out of business as an SME. So that is a but a short-term financial risk, but it can also be an opportunity. Richard, I don't know, do you want to do a final word on this?
No, I agree absolutely with that. I wouldn't draw much of a distinction between SMEs and larger corporations, to be honest, and partly for the reasons you've just described, but also because if you're a large corporation and you're required to report, that means you're required to report on your value chain, which means you will be asking your suppliers for information, no matter how large those suppliers are. So, you know, and the bigger picture here is in every business ultimately has to be involved in sustainability transition. So the scale is not really an issue. I think readiness is, proportionality and so on is important in all of this. But the principle of engaging with it is very clear and straightforward, I think.
Panelists, thank you so much for a really engaging discussion on materiality. We're at the top of the hour. We're closing our webinar. I'd like to thank all of our participants for really rich questioning and for joining us. And hopefully next time around, more will be able to get into the webinar, and we won't have this glitch the next time around. This is the end of the Materiality series of webinars. The next series starting on and it's always the second Thursday of each month. The next event in just a couple of weeks' time is on the beginning of our impact measurement and valuation series. I think you're going to find that incredibly useful, applying practice to measuring these things and then being able to report on them. Thank you so much. Be careful out there. If in doubt, always do the right thing. Follow GRI, CSRD, ISB, and do it the right way. Thank you all. Bye-bye.
Thanks so much.
Thank you.
Thanks, everyone.